Welcome to the deep dive. We are going to cut through the noise today on what was, well, just a huge earnings call.
Yeah, one of the most consequential of the year, for sure. We're talking about the Q3 fiscal year 2026 results. They dropped on November 19th, right after the U.S. markets closed.
And if you were watching the tape after hours, the reaction was immediate. I mean, overwhelming.
Oh, absolutely. Our mission for you today is to get past just the numbers. We want to really analyze the story they're telling, the strategy, and maybe most importantly, the kind of forward visibility they gave.
Right. That huge jump in the share price wasn't just a pat on the back for a good quarter. It felt like the market was completely recalibrating its expectations for the next, 2-3 years?
Exactly. It felt like it changed the whole mood.
Okay, so let's dive right in with a snapshot. This was a classic high-velocity beat and raise. They topped estimates pretty much everywhere.
The top line, the revenue, was just astounding. It came in at $57 billion.
Wow. And the street was expecting, somewhere around 55?
Right around $55 billion, yeah. So a huge beat. And to put that into perspective for you, that's 62% growth year over year.
And it's still growing 22% from just last quarter. The scale is hard to comprehend.
It really is. Then you look at the bottom line, earnings per share, both GAAP and non-GAAP, hit $1.30.
Which sailed past the estimates of about $1.26.
Yep. And for anyone listening, the non-GAAP number is usually the one to watch for core profitability. It, strips out things like stock-based comp.
Right. But the real engine, as everyone kind of expected, was the data center business.
Of course. That segment hit $51.2 billion in revenue.
$51 billion. So that's 90% of the entire company now?
Roughly 90%, yeah. 66% year-over-year growth. It is the story. It is the core of this whole global computing shift we're seeing.
And that massive scale is what lets them give the guidance that really lit the fuse on the rally.
Oh, it absolutely did. For Q4, they're guiding to $65 billion in revenue.
65. With a plus or minus 2% range. The consensus was under 62?
Just under 62 billion, yeah. So this tells you the ramp isn't just continuing, it's actually accelerating as we head into the next year.
Acceleration is the perfect word. So let's unpack that data center execution a little more. Management was really clear that this demand, it's not for old stuff, it's for the new generation.
It's an insatiable thirst, really, for the Blackwell and Blackwell Ultra platforms.
Okay, let's pause there. For listeners who don't spend their days tracking chip architectures, what exactly is Blackwell? And why is the demand, as the CEO put it, off the charts?
Right. So Blackwell is the newest architecture. It's purpose-built for the giant training and inference workloads that these new generative AI models require. It's a huge step up from the last generation, Hopper.
And the demand is so high
because the hyperscalers, the big AI labs, they all realize they need this level of performance right now to have any kind of competitive edge. So according to management, the cloud GPUs are, and I'm quoting here, effectively sold out.
And what I found fascinating was the product mix shift they talked about within that data center number.
Oh, yeah, the GB300 versus the GB200.
Exactly. They said the GB300 systems, the higher end ones, have already crossed over and are now about 2/3 of all the Blackwell revenue. That seems incredibly fast.
It is incredibly fast.
There it is.
It's a frankly brilliant financial move. The GB300 is the most dense, highest performance, and highest priced configuration.
The system, not just a chip.
It's the whole system, often with their Grace CPU packed in. And that rapid adoption tells you two things. One, customers are choosing performance above everything else. And two, they're buying the whole integrated solution, which locks them even deeper into the ecosystem.
So while data center is obviously the giant here, we probably shouldn't ignore the other parts of the business. The breadth of the platform still matters for the long term.
Totally agree. Look at gaming. It came in at $4.3 billion.
Which was up 30% year over year. That's the new RTX 50 series cards really starting to kick in.
And then pro visualization was also strong. $760 million, up 56%. That's all the creative and enterprise pros who need accelerated computing.
Then you have the more future-facing stuff, automotive and robotics.
$592 million in revenue there, up 32%. Now, I know these numbers seem small next to $51 billion.
Tiny, yeah.
But they show that the core technology is getting traction in these other really high-value markets, like autonomous vehicles and robotics.
Okay, let's pivot to profitability.
Yeah.
Because the scale is one thing, but the efficiency is what's truly Mind-boggling.
The margins, right. Non-GAAP gross margin was 73.6%.
And they guided for Q4 to be around 75%.
75%.
Yeah.
I mean, to maintain those kinds of margins while scaling production of this incredibly complex hardware, it's just extraordinary.
It really is. It speaks to their pricing power, which, is all driven by that CDA software mode. And those margins, they translate directly into cash.
A fire hose of cash. Free cash flow for the quarter was about $22.1 billion.
A huge jump from last year. And they're putting that cash to work.
They are. They returned $12.7 billion to shareholders in Q3, mostly through buybacks, and they still have another $62 billion authorized. It's a capital return machine.
Which brings us to the core narrative. I mean, before the call, there was all this nervousness in the market about a potential AI bubble.
Right. And the CEO just pushed back on that so hard, he laid out this whole philosophical argument for why this isn't a bubble.
He called it a virtuous cycle.
A virtuous cycle of accelerating demand. He said we're in the middle of 3 huge structural platform shifts happening all at once.
Okay, let's define those 3 shifts clearly for everyone listening. What's the first one?
The first one is the one we've been seeing for a while, the big shift from general purpose CPUs over to GPU accelerated computing. It's just way more efficient for heavy duty tasks.
Right, the basic hardware change.
Exactly. The second shift is generative AI replacing classical machine learning models in basically every major application. Search, recommendations, you name it. And that needs way more compute.
Okay, and the third shift, the one that's a bit more forward-looking.
That's the rise of agentic and physical AI.
So intelligent software agents and robots, basically.
Essentially, yeah. Robots, digital twins, industrial automation. The argument is that these 3 shifts are multi-decade trends, and every industry is going to need to build massive AI factories to keep up.
And that brings us to the number that really, I think, cemented the whole bull case. The forward visibility.
This was the jaw dropper. The CFO reiterated that they have visibility into over $500 billion.
$500 billion. 500 billion plus in revenue for Blackwell and the next-gen Rubin chips through the end of calendar year 2026.
That's what she said. And you have to ask, how real is that number? Is it just reservations?
Or is it firm orders?
Exactly. And while they didn't give specifics, the confidence in their tones suggests this is a multi-year order book backed by real committed capital spending from their biggest customers. It's why they're so confident the AI spending cycle has years to run.
And they name names to back it up. New partnerships with xAI, AWS, Anthropic.
That Anthropic deal was wild. A commitment for up to 1 gigawatt of compute capacity.
1 gigawatt? It's hard to even picture that scale. xAI is building what they're calling Colossus 2, the world's first gigawatt-scale data center.
It just shows you we're moving beyond simple cloud servers and into dedicated utility-scale AI infrastructure.
And the other piece of this that makes the platform so sticky is networking. That business is just on fire.
Hypergrowth, $8.2 billion in networking revenue, up 162% year over year.
So why is networking so critical? Why is it their moat?
Because when you're connecting thousands of these GPUs, you need incredibly fast, low-latency connections between them. That's where their proprietary tech like NVLink and InfiniBand comes in. And now, Spectrum-X Ethernet.
They made a really interesting point about Spectrum-X, didn't they?
They did. They said its attach rate is now on par with InfiniBand in the biggest AI deployments. So you have Meta, Microsoft, Oracle, all building these gigawatt factories using their Ethernet networking. It proves they're not just selling a chip, they're selling the entire integrated AI factory. You can't just swap out one part.
Okay, we have to address the big risk factor, the elephant in the room, the China question.
Right, the U.S. export controls. And management was crystal clear here.
What was the bottom line?
The bottom line is they assume 0 China AI accelerator revenue in their guidance.
0.
So that massive $65 billion Q4 guide and the $500 billion visibility, that's all based on demand from the rest of the world. They said sales of the sanctioned H20 chip were only about $50 million.
So the lost China revenue is basically a rounding error compared to the global demand.
It's being completely absorbed and then some.
And looking even further out, they gave us a little taste of what's next. The Rubin platform.
Yeah, that's on track to ramp in the second half of 2026, the Vera Rubin platform. It's supposed to be another massive leap in performance over Blackwell, powered by 7 different chips.
And that relentless pace of innovation is their main defense against competitors, right?
It is. Their argument is basically, our innovation is so fast, And the CUDA software layer is so stable that by the time a competitor ships a chip, it's already on its way to being obsolete. It gives them a huge total cost of ownership, or TCO, advantage.
Which brings up their strategic investments.
Yeah.
They're putting money into customers like OpenAI and Anthropic. Is that just a financial play, or is there something deeper going on?
That's a great question. And no, it's not really about the financial return. It's explicitly about expanding the ecosystem.
So making sure everyone is building on their platform.
Exactly. When you invest in a company like OpenAI, which is scaling up to 10 gigawatts of data centers, you're ensuring their massive models run perfectly on your hardware.
So the investment is kind of like a technical partnership guarantee.
Precisely. Look at the Anthropic deal. It's a deep technology partnership to optimize their Claude models for CUDA, to squeeze out every last bit of performance per watt. Once a model is that deeply optimized for CUDA, the cost and effort to switch to a rival's hardware becomes, well, almost impossibly high.
Okay, let's balance all this good news. We have to look at the risks and the constraints. It can't all be smooth sailing.
No, and it's essential context. They are spending aggressively to stay ahead. OpEx is guided to be up 36 to 38% year over year. That's a lot of R&D.
And what about the external constraints? The things they can't control?
Right. They mentioned two big ones, power costs and grid capacity. Yeah, you can't just build a gigawatt AI factory anywhere. You need a massive amount of reliable, cheap power. And then, of course, geopolitics. The US-China tech war is always a risk that could expand.
And their defense against competition was that TCO advantage we mentioned.
That's the ultimate defense. They pointed out that their A100 systems, which are, 6 years old now, they're still running at full utilization today.
Because of the CDA software update.
Because of the software. That hardware has an incredibly long, useful life. And if you're spending tens of billions on infrastructure, knowing it won't be obsolete in 2 years is a massive, massive advantage that a custom chip just can't match.
All right, we have dissected the numbers, the strategy, the risks. Now we get to the segment where we have a little fun, the exercise in strategic imagination.
And we absolutely have to say it. This is not financial advice. This is purely a thought experiment.
Okay, so given that $500 billion revenue visibility and the $22 billion in free cash flow just this quarter, our outrageous but plausible idea is all about leveraging that guaranteed future income.
The basic idea is that a company with a guaranteed $500 billion order book is just fundamentally mispriced by the market today. So management should use that to their advantage.
The move. Go out and issue a substantial amount of high-grade, long-term corporate debt. I'm talking aggressively, say $50 billion right now.
Right, while your balance sheet is spotless. And then you take that $50 billion and you immediately fund a massive, front-loaded, accelerated stock buyback. Way more than the $12.7 billion they're doing now.
The company is so cash-rich and its future is so visible that the risk of servicing that debt is minimal.
And that debt-funded buyback would be instantly accretive. You're using cheap leverage to buy back shares in a high-growth company with guaranteed demand.
It's a power move designed to force the market to re-rate the valuation, immediately. It shows extreme confidence.
It's a super aggressive capital move, but one that is actually underpinned by a level of visibility that we've almost never seen in modern tech.
So what does this all mean for you, the listener? Well, the Q3 beat, that huge $65 billion Q4 guide, and of course that foundational $500 billion order book.
Yeah.
It all cements the multi-year bull case for AI infrastructure.
And the final provocative thought we want to leave you with is about the CEO's third structural shift, the move to agentic and physical AI, robotics, digital twins.
Right. The hyperscalers have already built their gigawatt factories. So the question for you to think about is, what specific industries outside of the big cloud giants are going to be the first to fund and build their own multi-gigawatt compute factories?
Will it be the automotive industry?
Yeah.
Energy? Biotech? Or something we haven't even thought of yet?
That's the question that will determine where the next wave of this investment goes. Thank you for joining us for this deep dive.
We'll catch you next time.